You're welcome to my channel. In this video we are going to be looking at royalty accounts in accounting. So we shall start by defining the meaning of royalty. Royalty is a periodic payment. A periodic payment, it means that it is paid after a certain period of time. It is a periodic payment to the owner for the use of his ownership right. That's what we call royalty. Periodic payment to the owner for the use of his ownership right. So here we have two parties. We have the landlord and then we have the tenant. So the landlord is the owner and then the tenant is the user. So an example that we can give is a musician, someone who has their music, and then this is a musician, so this person comes and they want to sell this person's music, they want to sell copies of this person's music. So they have to make an agreement. They have to make an agreement between both of them so that this person can be able to sell the music of this person, and every time this person sells the music, he's supposed to pay a certain amount of money to the landlord. Another example that we can give is if this person owns a book, they wrote a book and they published it, so it belongs to this person. So this person wants the rights to sell this one's book. So they'll have to make an agreement so that every time this person sells this one's book, they give the owner a certain percentage of the money that they have made. So that money that is given is called royalty, but that money is not given after a sale, in that after a book they give him the money. No, they can say that we are going to be giving it to you monthly or annually, something like that. So it is a periodic payment to the owner for the use of his ownership right. That's what we call royalty. So royalty arises in respect of the following. For example, for the extraction of minerals from the ground. If the landlord has land and this land has minerals and this person wants to extract minerals from this one's ground, they will have to pay him a certain amount of money every time they extract from his land, and that money that is given is what we call royalty. Then another circumstance is for publishing books with permission from the owner. Another circumstance we have is for use of artistic work. Artistic work like music, movies, etc. So these are some of the circumstances that lead to royalty, that bring about royalty. Extraction of minerals from the ground, publishing books with permission of the owner, then the use of artistic work like music. Then let's look at the forms of royalty. Principal forms of royalty. Royalty is in three forms. We have meaning royalty, then we have patent royalty, then copyright royalty. Those are the three. So extraction of minerals from the ground brings about mining royalty. Then for publishing of books, it brings about the patent royalty. Then copyright is for artistic work. That's how it goes. So patent and mining royalty are paid on production. These two are paid on production. Then copyright, it is paid on sale. Every time you sell someone's music, or every time you sell someone's movie, you pay them. Paid on sale. Then for this one, every time you produce, you pay the owner or the landlord. Yeah, so these two parties, the landlord is also called the leaser, then the tenant is called the leasee. Yeah, so let's look at the key terms. The key terms that we shall be using when it comes to royalty. The first one we have is called minimum rent, also known as dead rent, also known as rock rent, also known as flat rent. So minimum rent, it is the minimum amount of money. The minimum amount of money that must be paid by the tenant to the landlord in any particular year. Even if the tenant hasn't derived any benefit from the asset. So if these two parties make an agreement, like every time you sell my music, you're supposed to give me a certain amount of money. So they also come up with what we call minimum rent. So this is the amount of money that the tenant must give the landlord in any particular year, even if they don't derive any benefit from the asset. So even if this tenant doesn't sell the music, or even if they don't derive any benefit from the asset. So if we are using an example of music, even if the tenant doesn't sell the music, they are supposed to pay the landlord a certain amount of money, so they can come up with a minimum rent of 1M, and the landlord is like, in any particular year, you're not supposed to pay me any amount that goes below 1M. So 1M becomes the minimum rent, but they can pay the landlord any amount that is above in case more money was made. But even when no money was made, the landlord is supposed to get his 1M. So that is what we call the minimum rent. It is the amount of money that must be paid by the tenant to the landlord in any particular year, even if the tenant has not derived any benefit from the asset. Then the second term that we have is called short workings. Short workings. So this is the excess of minimum rent. Over actual royalties earned by the landlord. So let's give an example. In a particular year, let's say in 2024, this tenant makes 900K out of the landlord's music. So they already made an agreement that you're not supposed to pay me money that goes below 1M. So our minimum rent is 1M already. And this person made 900K from the music. So meaning they are supposed to get money from their own pockets, which is 100K. And then top up to give the landlord his 1M. So this top up is what we call the short workings. So it is the excess of minimum rent over actual royalty. The actual royalty was 900K, so the short working is 100K. When you add both of them, you get a money. So it's the excess of minimum rent over actual royalties earned by the landlord. Then another term that we have is recoupment of short workings. This refers to the recovery of the short workings in a period where the landlord earns excess in royalty over minimum rent. So recoupment can also means recovering. So recovering of short workings. So it's the recovery of short workings in a period where the landlord earns excess in royalty or minimum rent. So when they are signing an agreement, they can agree that the tenant is allowed to recover the short workings that are incurred in the first year, or in the first 2 years, or in the first 3 years. So depending on the agreement, the tenant can recover the short workings that were incurred. So in 2024, the tenant incurred short workings of 100,000. So maybe in 2025, the tenant made 1.5 1.5 from this person's music as the actual royalty. So this is the actual royalty. But then according to the agreement, in case there is excess money made above the minimum rent, the tenant is allowed to recover the short workings that were incurred previously. So in 2024, we had incurred short workings of 100. So the tenant is going to first subtract their money. So they will get 1.5 minus 100k. What they get, the balance, is what will be given to the landlord. So that process of deducting the short workings that were incurred previously is what we call recoupment of short workings. So the landlord will be given 1.4 after deducting the 100k, like that. So that's what we call recoupment of short workings. It refers to the recovery of short workings in a period where the landlord earns excess in royalty over minimum rent. So this can only happen when the actual royalty is above the minimum rent. So here it was 1.5, it is above 1M, but if it was like 800k, recovery of short workings wouldn't be possible because 800k is already below the minimum rent. Yeah, so those are the key terms that we are going to be using when it comes to royalty accounts. Then the accounts that we are going to be looking at when it comes to royalty accounts, we have the landlord's account, royalty payable account, and the short workings account. Those are the three accounts that we are going to be looking at. Thanks for watching. In my next video, we are going to be having an example on royalty.